So thus far in 2022, we have already seen a negative returns of the S&P 500 index of roughly 10%. We've also seen negative returns of companies like Netflix of 35%. We have seen negative returns of Nvidia and Tesla of roughly 22%. And lastly, we've also seen negative returns of companies like Apple of 13% roughly. We are not only seeing negative returns in stocks, we're also seeing it in cryptocurrencies, in all index funds, and basically in every single investment thing there is, we are seeing negative returns right now. Within investing, there is something known as the January effect. Usually in January, we do see very, very high positive returns, and it is actually historically the best month of the year. However, that is far from the truth this year, and we are seeing absolutely massive negative returns. So I'm going to go over some of the reasons as to why this could be. So in order to explain the negative returns that we do see in the market right now, I want to start out by talking about the Federal Reserve in the US. Basically, there's two things that I want to touch upon when it comes to the Federal Reserve. The first thing is interest rates, and the second thing is inflation. The first thing I want to talk about is the interest rates right now. Within the last couple of years, we have had extremely low interest rates, and they have never been as low as they were. But right now we are seeing an increase in the interest rate, and it's actually getting close to 2%. And it is expected that it will increase to 2% during 2022. Now, when the interest rate is low, it does increase consumption, and people are more willing to invest, and they are also more willing to take on risks. And when people take on excessive risk, it's not always a good thing. And when you do take on excessive risk and the interest rate starts increasing, as we're seeing right now, then it does have some absolutely detrimental effects on your overall portfolio. So this is one of the things that we do see in the market right now with the interest rates increasing. So the second thing that I wanted to talk about is inflation. Basically, the inflation has never been this high during the last 40 years as it is right now. It is expected that during 2022, we will hit an inflation of 7%. An inflation of 7% basically means that you can expect that everything you buy will get 7% more expensive in 2022 than it was in 2021. This is a very, very high increase in prices, and when we do have these increases in prices, we often see that we as consumers, we start to sort of like reduce our expenses. We start to not buy the things that we don't need to buy because they are now getting expensive. This does have some effects on the overall economy. For example, when we don't buy, it basically means that the companies are not earning the same as they did previously. But also, if you are a company and you do have a increase in inflation, it basically means that the things that you want to buy in order to produce your products, they do increase in price. So you have to pay more to produce your product. And we as consumers, we don't really buy the products that they produce anyway. So it is sort of like a very, very bad effect, and it does have some negative effects on the overall economy. And a combination of high interest rate and high inflation will probably have some sort of impacts on the overall growth of the economy in 2022. So the next thing that I want to talk about is actually the price of oil. The price of oil is something that I personally follow very, very closely right now. And I also know that very many professional investors are doing the same thing. Right now, the price of oil is actually getting close to $100, and the price of oil has absolutely been exploding through 2022. If you look back in history and you see when there has last been such high increases in prices, you have to go back to 2007, 2008, where we had the financial crisis. We also had huge increases in oil prices around year 2000, where we had the dot-com bubble. So basically, the price of oil has historically been known as sort of like an indicator of a potential financial bubble. So therefore, it is something that professional investors, they do follow very, very closely. And right now, it is at absolutely enormous heights. And the thing about oil is that the society and the overall economy is very, very dependent on oil. Oil goes into basically everything. Every production company uses some sort of oil, or at least 99.9% of them use oil in one way or another, or at least the components that they buy have been produced by oil or something like that. So we are very, very dependent on it. And when there is increases in oil, then there is increases in production prices as well. A high inflation combined with high increases in oil prices usually leads to very, very bad circumstances for production companies. And since production companies are such a huge part of the overall economy, there could be potential problems of having this high oil prices compared or combined with high interest rates, or not high, but higher compared to the previous years, and a high inflation rate. So these are some of the indicators that there could be a potential bubble right now, and these are some of the indicators that does sort of like provide a lot of concern to the investors and to the overall market. And I do believe the combination of these three things, among maybe a couple of other things, are the reason why we do see such high negative returns in the market right now. So the next thing I want to talk about is sort of like the COVID-19 situation. So basically, ever since COVID-19 started, we've as investors experienced absolutely insane returns as investors. And I don't think very many of us actually anticipated these returns when sort of like the news of COVID-19 started, and especially not when we saw that countries were closing down their businesses and all of those things that we've seen sort of like the last couple of years. However, we have seen very, very extraordinary returns during the COVID-19 pandemic. And right now we are in a situation where sort of like those problems that actually came based on COVID-19 is starting to emerge. One of the problems that came with COVID-19 is supply problems. Basically, we've had harbors, very, very big harbors in Asia that is basically closed down for weeks and weeks and weeks. And the problem with this is that all the ships that actually comes to Asia with their goods, they can't really drop it off. And all the ships that sort of like has to go away from there to different places in the world, they can't really get sort of like the containers on their ship. The result of this is that there is major supply problems. Basically, it is very, very hard, as many of you most likely have experienced as well, to get things delivered on time. Basically, all of this has also increased in a very, very high transportation cost. The container prices has more than doubled over the last year alone, and the year before that it also doubled. So basically we have a triple price of containers, and also sort of like the road traffic or the road transportation prices has also increased. So overall the transportation cost has increased a lot, and most likely we as consumers have also seen that when we buy things online, that we have to pay this transportation cost all the time now, and most likely we also have seen that there has been an increase in this transportation cost. So that is some of the problems that COVID-19 has caused, and I do think sort of like the effects of that is starting to show in the market. So the next thing I want to talk about is new investors in the market. Very, very often when we do see very, very high returns in the stock market over a couple of years, we do have new investors coming into the market and thinking that they can make some easy money in here. So basically, when new investors, they do experience negative returns, they tend to panic. And I do believe that this is what we're seeing as well. And when they panic, they start to sell all of their stocks, because right now they are afraid that they will basically lose all of their value. This is something that we've seen multiple times over history, and I do believe that is what we're seeing right now as well. I do believe that many of the investors who came in during the last 2 years, they have started to sell out of their stocks right now, because they are afraid of the market circumstances, and they are afraid that they will lose even more money by staying in there. If we look at what the typical new investor buys when it comes to stocks, then they usually buy sort of like these high-priced grow companies, and I do believe that it is very, very evident in the market right now that there's very many sort of like tech companies, for instance, with extreme high PE valuations. Even though they've also increased their earnings over the last couple of years, their PE is still extremely high. Within this valuation that they are given in the stock market right now, it is expected that they will have, or that they will experience absolutely tremendous growth throughout the next couple of years. And if they don't, then then the stock will basically fall in value. And I do believe we see that right now. Right now, a lot of things in the market is changing. We have high interest rate, we have inflation, we have supply problems due to COVID-19. Basically, all of these things have changed sort of like the future circumstances for these companies. Basically, a lot of these things does have an impact on their earnings, such as the supply problems, the inflation, and then you have the interest rate, which also does have an impact on their earnings. But it also has an impact on the discount factor that you use in order to calculate the actual value of a company. And when you have a decrease in earnings and you have an increase in the discount value, then you will reach a much lower valuation of these companies. And when they are priced extremely far above what they are currently earning, then it is more or less obvious that they will experience a huge increase or decrease in their prices when sort of like these market circumstances change in unfavorable terms for them. And that is what we're seeing right now. So basically, if we are comparing 2022 to 2021 and 2020 even, we do have very different market circumstances. We have high inflation, we have increased interest rates, we have new investors, we have very high oil price, and we have these supply problems that sort of like have emerged from COVID-19. So I do believe a combination of all of these mentioned factors is what basically is causing the market to decrease in value now. Thus far, we have seen a decrease basically not just in sort of like these companies with a very high PE, but we've seen it in all of the indexes basically. And what I personally do believe is that it's very healthy for the market. We have had cases where it's been normal for a company to be above 40 or 50 in PE for a long period of time. And if you look at a company like Tesla that has an absolutely insane valuation right now and an absolutely very high market value. I'm not saying that these companies do not deserve it. I'm not saying that they don't go further up in price, because I actually do believe that they will. What I'm saying is that when the circumstances of the market does change, then it is expected that companies with such high valuations that they will fall in value. And that is what we see right now. And I do believe that we will see many of these high value tech companies go even further down than they already have thus far. So now I've said some words on what is actually happening in the market and why it is happening. Now I want to talk about how all of these circumstances sort of like changes my strategy and my view on investing in 2022. So basically, first of all, whenever we are about to change from a strange year, I always look at my portfolio and I see whether or not I should adjust certain things. And what I saw back in December, last in December, was that I had so many of these tech companies. I had Amazon, I had Apple, and I had Tesla as well, and I had very many of these companies. And I started to look at my overall risk. Basically, I didn't like the overall picture of it, so I decided it was time to sell some of these companies, because I in my opinion, I was taking on way too much risk according to what I should be doing. So therefore, I decided to sell some of these stocks. However, I do still own very many of them, so I've also experienced what it's like to have stocks that are decreasing a lot right now. But basically, my overall approach to investing is based on value investing. So I do like companies that are traded at a very fair value, and I do want to sell companies that are overvalued. So that is what I'm trying to do here. This also means that my strategy when it comes to investing really haven't changed much. Right now, when I look at the market, I still want to buy stocks, and I do see a lot of stocks that have decreased a lot in prices and that are right now very attractive. So what I'm going to do is just continue what I've always been doing, and that is what has worked for me thus far, which is buying every single month. Every single month I do use a dollar averaging cost model in order to buy stocks with. So basically, when I do get my monthly salary, I will buy stocks again this month, and I will continue to do so for the next years. I'm not buying because I do believe that the stocks won't decrease even further. I'm buying because I do believe that in 5 or 10 years, the market is going to be worth a lot more than it is right now. And that is the sort of like hypothesis that I'm buying on. When it comes to predicting the market and the movements of the market, it is something that is absolutely extremely hard to do, and it is something that I do believe only a very few people on earth can do, at least profitable over time. And I don't think that I do have the experience or anything to call myself one of these investors. So what I do believe is the best strategy for me is to go with what historically has worked the best. And that is to stick to your strategy and keep buying every single month and hold these stocks until they increase in value. when you think about it, you don't really want to sell stocks that already have decreased 20% in value. That's when you want to buy them. And then you want to sell again when they increase in value, right? And that is what I'm actually going to do. I do believe that if I should have sold my stocks, I should have done it 3 or 4 weeks ago. Doing it now just doesn't make any sense for me at all. So therefore, I'm going to stick to my strategy and I'm going to buy stocks every single month. I don't really care how long this recession is. I'm going to stick to what it is that has been worked for me thus far. So basically, my strategy just does not change much just because the market has changed. What is changing though is the companies that I want to look at. Right now, I'm not looking at high risk stocks because I don't feel comfortable buying them. Right now, I'm looking at very, very slow growing companies. It could be companies such as Visa, it could be companies such as Coca-Cola, and all of these basically dividend aristocrats that has been there for a very, very long time, that has a very, very good cash flow, and that I know are capable of withstanding a recession, basically. That's the companies I'm looking for. I'm not looking for these Tesla companies, these tech companies, these growth companies right now. I do believe that 2022 is going to be a year for value investing, and I do believe that in 2022, I'm personally going to focus a lot on value investing and buying companies that are not completely overpriced. I do like owning companies that have the potential to increase a lot, but I do not think that 2022 is the year to do so, for me at least. So therefore, I'm going to stick with what I feel comfortable doing, and that is buying the value stocks right now. Then maybe in a year or two, I will sort of like look at my portfolio again, and I will see, okay, maybe I should add more high risk stocks into my portfolio and see how it goes. But that is how it is for now.